Now, as many of you know, part of my process, especially over the weekends when I'm analyzing the market, is to be very open minded, look at the positives and the negatives, and maybe adjust my investment levels accordingly, but make sure to be flexible in your approach and really focus on what the market is doing rather than what you want the market to do. So, anyways, let's go through the positives. The major indices are above their key moving averages. This is the NASDAQ composite. It's above the red line here, the 50-day moving average, and the green line, the 21-day. When you look at the weekly chart, the red line is the 10-week moving average, and we're above that. Shifting over to the S&P 500, same thing for the most part. We've just been in a very strong uptrend, still holding that 10-week line. And on the daily chart, same thing, just in a strong power trend, holding both the 50-day and the 21-day. So that's a positive sign. The reason that's important is if you remember, hopefully you've watched the educational videos, signs of a healthy market. One of the signs is just a simple sign of the major averages being above the 50-day is just in general a green light sign of a healthy market. So that's good. The leaders, especially the mega caps, this is a second positive. The leaders are acting well. Why this is important is because the big institutions control the market. They tend to traffic in a lot of the mega cap names when they need to put hundreds of millions, if not billions of dollars to work. So it's important to follow the leaders. There we go. So Apple just came up. Apple broke out of this big base, had great earnings, continues to hold that 21-day. Again, sorry to be so repetitive, but the 21 EMA in strong markets, strong stocks, strong ETFs tend to hold that 21 EMA. So when a lot of the mega cap leaders are above that 21 EMA, that's a good sign. When you go through Apple, Microsoft, a little bit extended, but still holding that 21 EMA. Just to go through some of these quickly, Shopify still holding that 21 EMA and consolidating well. Google, Alphabet, parent company of Google, a little bit extended, but has been very, very strong. And even Facebook, after their earnings, dropped down to that 21-day, holding up well. Square was one of the setups I mentioned recently, sort of building this big base here, pulling back to that 21-day, pulling back on some light volume after a deal that was announced last Monday pre-market, and just continues to act well with some nice signs of accumulation and incredible triple-digit earnings and sales growth the last couple of quarters. So, as always, if you're not sure which mega cap to buy, the QQQ is the NASDAQ 100 ETF, gives you broad exposure to a lot of these great companies. So, positive number two, the mega caps are acting well. The other thing going back to the NASDAQ is from a sentiment point of view, every time we have a little bit of a drop and we pull back to normal pullback, the sentiment's off the charts as far as we're not in a euphoric market. Everybody has one foot out the door. You can see it by people raising cash, shorting the markets, jumping into puts. I'm not saying to be complacent. I'm just analyzing sentiment as a secondary measure from a contrarian point of view. Why sentiment's important is because the market tends to fool the majority. So when we had just to reset the lines here, when we had a normal breakout of this range here and a normal pullback, which is perfectly normal price action to have a pullback, on this pullback, some sentiment measures got to higher levels of bearishness than right around here, around the presidential election last November. So again, that's from a contrarian point of view, a good sign. And then the fourth one is Fed liquidity, which I want to try to discuss briefly, is that there's tons of liquidity being provided into the market by the U.S. Fed and all the central banks through their bond buying purchases and through their basically zero interest rate policy. And everybody is concerned that when are they going to stop with this bond buying, meaning tapering, reducing their bond buying purchases and raising interest rates. They've made it perfectly clear that they're not going to taper until 2022, and they're not planning on raising rates till 2023. But everybody's still nervous. Everyone's saying this is unnecessary. They're doing too much. And again, I don't argue with it. I just say take advantage of it. They've made it perfectly clear that they would rather be late than start early. And a couple of things with last Friday's jobs report. So the first Friday of every month, the unemployment report comes out. And a couple of Fed officials have said if we see two strong employment reports in a row, then we might need to start tapering sooner than later. So when Friday's report came out stronger than expected, the market had a little bit of nervousness, and some of the tech names came in as interest rates climbed up, the 10-year climbed up, and some of the financials benefited from that. You can see it with Goldman Sachs, for example, closing at an all-time high. So the financials are benefiting from that because some people are anticipating that interest rates are going to climb. My feel on this is that they are not going to do anything until 2022, and they'd rather be late than start early. And also, it's just one jobs report. If the next one is weaker, then it'll be back to we're not going to taper. But the other major factor is the Delta variant that's throwing sort of a curveball into all this. I think the Fed wants to make sure that the case numbers come down before they do anything. And also, what's coming up after the next jobs report, before you know it, is holiday shopping season. I think the last thing they want to do is rattle the markets by being hawkish into what could be a fragile holiday shopping season. They want to make sure things are recovering well. So that's just my 2 cents on that. Overall, though, the Fed liquidity is a huge positive. As far as the negatives, Russell 2000, it's still in a range. It's not a serious negative. I mean, it ran up, and I've talked about it's still in a range, but it is slightly still below that 50-day, not far below it, but at least it's stabilizing. And then the S&P 400 mid-cap, I talked about, maybe a few sell, 3 waves down of selling, but it was nice to see. So this is kind of a positive. It's back above its 50-day. But I would say the other negative that is I talked about in recent videos is seasonality. I'm here to remind you of times on the calendar, take a step back, look where we are in the bigger picture of things. And August and September tend to be traditionally, statistically, 2 of the weaker months of the year. So, it doesn't mean we have to drop. It's just times where the news cycle, I think after this week, over 85% of S&P 500 companies would have reported earnings. So the news cycle will shift into the second half of August and into September, into geopolitical concerns, interest rate garbage, what else? Virus statistics and so forth. So the news shifts away from fundamentals to other garbage that can tend to rattle the market. So the conclusion here is it doesn't mean we have to drop. I'm just saying to be prepared for maybe a little bit more volatility in periods that are traditionally or statistically could be more volatile. I talked about my strategy is that prior to this week, coming into this week, the first week of the month tends to see new money flowing in. So I increased my investment level, stayed pretty fully invested into this week. And I said if it was a strong week, which it was, for the week, the NASDAQ was up over 1%. And it was a strong week for a lot of growth stocks. I said if we do have a strong week coming into this week, and I reminded everybody in the midweek video on Wednesday that I might look to reduce a little bit, and I did reduce a little bit. Ways you can reduce are through stopping yourself out. Obviously, if anything that breaks down, maybe lightening up on a position. Let's say you have a 5% position on something, you can reduce it to 3. That's another option. Or just to minimize your number of positions. Maybe if you own 20 positions, reducing it to 15, something like that. Again, my style of active management's not for everybody. I'm just trying to give suggestions for people who are looking to reduce. If you're longer term and you're okay with a little bit of volatility, then stick with your positions as long as you have a cushion and a good entry point. But I also want to say that looking at the positives and the negatives, I don't see any sustained downside for the reasons I mentioned, the positives in the market, and also that if we drop, I think everyone's going to be fearful again, and that puts a little bit of stability to the market. So maybe we have, over the next 6 weeks, a normal pullback to that 50-day moving average, which is not really crazy, a crazy call or any sort of like abnormal price action. You can see here the S&P, I talk about every once in a while, comes down to that red line, the 50-day. So maybe we could maybe even drift a little bit higher and then come down over the next several weeks. So that's just something to keep in mind. It's not crazy volatility. In the grand scheme of things, it's normal price action. I'm here to promote calm, confident traders. So when things drop, don't think that this is the end of the world. Relax a little bit and understand. The more you study price action, you'll understand what's normal and what's not. So I just think it's possible that we could maybe drift down to that 50-day to set up for maybe a fourth quarter rally. And as I also mentioned in the midweek video, maybe an ideal scenario, which is almost too ideal, is to just go sideways and correct through time, meaning time goes sideways rather through price by going down to the 50-day. So it's just something to keep in mind. Nevertheless, the basic principles are intact, which is focus on strong stocks. I told you, I'm here to keep you on the right side of the market. I think I've done a very strong job of that. I haven't talked about shorting. I'm not calling for the end of the world. We're above those key moving averages. The market's healthy. I'm reminding you of that. So that's step number one, keeping you on the right side. When it is healthy, number two, focus on the strongest stocks, which I'm trying to do through these videos by giving you a great list of idea generation of some of the strongest stocks that I'm finding. Number three, get those strong entry points. As I've said a million times, no matter what your time frame is, short, medium, or longer term, get those strong entry points so you have a cushion potentially when you have a nice run for that volatility or normal pullback. And number four is always manage risk. Any decisive close below the 10-week on any of these stocks is a suggested stop. Again, because that's an area of institutional support. So when the institutions are no longer supporting the stocks, I'm not interested in supporting them as well. So those are just basic sort of concepts to keep in mind as we head towards the end of the summer.